Hello, welcome everyone to our Pellegrini Financial second quarter market update video call. Lots to go through, so let's hop right into it. We look first at, I guess, the overall market and global market performance. The first two I'll talk about really is the Canadian market, which has been the strongest market, or one of the stronger markets on a year-to-date basis. On the quarter, the Canadian small cap was one of the stronger performers, and also the tech-centric, I guess Nasdaq in the U.S. had a strong quarter as well, although flat for the year because they kind of were struggling in Q1. But they were certainly the first top two performers in this Q2. When we look at some of the detractors, the euro and the Chinese markets were both negative on the quarter. Positive year to date still, but negative in the quarter. A lot of that is tied to tariffs and the trade deal. I don't think the euro markets in particular look too fondly at the trade deal with the U.S. The Chinese, of course, haven't set a trade deal yet. So again, that's some uncertainty in that market that, again, created as a detractor. When we look at the sectors and the Canadian sector and performance down here at the bottom, materials is still the strongest on a year-to-date basis. Healthcare was one of the detractors on a year-to-date basis. Again, actually, the exact opposite of what it is in the U.S. The U.S. was really a stronger component or sector for the U.S. market, healthcare and technology, of course. And so a little bit of a difference here between the Canadian and U.S. sectors in particular. When we move over to tariffs and Canadian GDP, Canadian tariffs, of course, were front and center in every coffee shop, every conversation, to be honest. This top chart, I just wanted to kind of highlight here, this blue or darker blue section here in each of these bar graphs, just illustrate the amount of the trade in Canada going to the U.S. that is compliant to USMCA or the old NAFTA trade agreement. Those amounts of trades are 0% tariffed. So there is really no concern in regards to what tariffs are being applied. And as the months have gone by, more and more corporations have tried to get compliant with the trade deal because then you got a 0% tariff. Obviously, those that don't comply, and obviously there's carve outs between steel and auto and forestry and so on, you pay that higher tariff. And the smaller companies probably have a tougher time in complying to the trade deal, and so they might struggle, obviously, with these higher tariffs. Tariffs as a whole, though, is something where when we go back to April and there was a big market, downfall when tariffs were first being applied, that has kind of gone by the wayside, and there's a bit more, I won't say comfort is the right word, but become more normal in understanding that tariffs are going to be here to stay. So markets have come more accustomed to it. Um, Canadian GDP, which is this bottom chart, has held up quite well through Q2. And so, at this point, maybe stronger than expected. Obviously stronger than what has been over the last year or more based on these bar charts down below. So 2025 certainly is shaping up to be a better year for Canadian economic growth. I do not really expect that to hold maybe through the back half of the year. Now, some of that will be dictated upon whether any agreement is reached with the U.S., even though we don't, it's a minor portion of our trade that is not compliant to the old NAFTA. There's still components that aren't. And so that does have an impact on economic growth. Tariffs as a whole will have an impact on economic growth. We'll come back to that in a little bit. Interest rates and inflation. Interest rates and inflation, of course, we touch on every time. But this top chart just shows the consumer price index or inflation in Canada. We had that big uptick through 2022. It's come back down. We're pretty much steady now at 2% or a little less. Obviously, the Canadian or the Bank of Canada overnight rate, we've had, a number of cuts here early through 2024 into the earlier part of 2025. We've held steady now for a little while. Canada was coming probably early, certainly came further along in the rate cutting cycle than most other economies, certainly the US. And so while there's been no rate cuts as of late for Canada, I wouldn't be surprised to see one here towards the end of the year. That might be a little dictated on how tariffs and trade negotiations can go on as well. When we look at the bottom chart, the Fed funds rate, and that's where, again, rates have not been cut for the last couple of meetings. But the expectation is at least one, if not two, rate cuts before the end of the year. That green bar there that I kind of put into that chart, kind of illustrates where the expectation is of rate cuts going forward. I know they haven't been cut as fast as Trump would like. He's made that loud and clear, but there is still an expectation from the markets that rate cuts will happen. And I think with inflation kind of not as low as Canada and the U.S., but kind of set in stone now, 2.5%. The Fed does have room to cut. When we look at currencies and commodities, this top chart here, I'm going to focus on the commodities first with the gold highlighted in green. Had a strong quarter, but also been one of the stronger asset classes on a year to date basis. And of course, some of the central banks, including China, other central banks have been buyers of gold throughout the year. That might start to wean itself off that a little bit. Obviously, gold price still remains elevated through the rest of this year. Natural gas has been one of the detractors in the commodity markets. Still positive year to date, but again, in this past quarter, natural gas has been down quite significantly. When we look at the Canadian dollar had a great quarter in Q2, so I highlighted that at the top chart. But also, this bottom chart is the Canadian dollar versus the US versus Canadian from the start of this year, and that's kind of this the red line is highlighting. So while Q1 was kind of a flat in regards to currency exchange between Canada and US, Q2 was very positive for the Canadian dollar. And I wouldn't attribute that to Canadian dollar strength. It's more so US dollar weakness against all other currencies for the most part. At the end of the day, though, we'll take it because that is a good positive for the Canadian dollar, good for snowbirds who want to go down south for this winter. I don't know if there's much more strength in the Canadian dollar at the moment. It's probably somewhat range bound to where it is at the moment. That'll be probably dictated by how economic growth is continuing here over the next little while. And again, when we look at GDP and employment, of course, in particular, was positive, I guess, in Canada. We had a little bit of a decrease in the unemployment rate from 7 down to 6.9%, and that's what this top chart kind of illustrates. The U.S. is a bit of a different story. I mean, it's positive in the sense that it's been positive job gains. The negative, of course, has been the fact that the revisions have been downward. So while the initial employment numbers seem quite strong, the revisions had lowered that number, weakened it, and obviously Trump again did not like that, so he fired his head stats person on the labor market. But again, those revisions were downward, and that happens quite commonly, to be honest. But again, showing a little bit of weakness in the employment numbers, both in Canada and the U.S. When we look at this bottom chart, this is more for your interest more than anything else. Interesting. Tech job postings on Indeed Canada. So we saw a big spike in tech job postings through 2022, and 2023 it started tailing off. We've talked a lot of artificial intelligence in past calls, and artificial intelligence is one thing that's become more embedded into our different economies in different ways. And it does impact technology as well in the sense that even jobs in the tech space are lost to AI. And that's a big part of what this chart kind of shows. Even companies like Microsoft has laid off employees. Software programming, I mean, that's something that AI can do now much more efficiently, much more cost effective. And so AI has evolved in different ways, including tech companies itself, which is quite interesting. Um, when we look forward into Q3, a number of things are to watch for, and obviously tariffs are still going to be first and foremost in the conversation. No matter how you cut it, tariffs are going to be an impediment to economic growth. Always have, always will be. And so, as much as Trump and the U.S. government might promote their tariff numbers for what they're collecting as revenues, those are gross revenues. There are net revenues that are going to get deducted from that because at the end of the day, you're going to have lower economic growth. It doesn't matter how you cut it. And so that's loss of tax revenue. Consumers are going to eat some of those tariff costs because of higher costs. Corporations are going to eat some of those tariff costs because of higher costs of doing business. And so while that gross revenue looks nice and juicy, it is not really the net revenue if you really boil it down. Tariffs are an impediment to economic growth. Now, how much of an impediment? Time will tell. But that is part of what I think the economy markets will certainly be watching. At the end of the day, currently though, corporations have been showing very good earnings in the US in particular. And so that is a positive momentum that's going to carry on. We don't see that changing anytime soon, at least until next earnings reports. When we look at the fixed income space, again, fixed income has been much more stable here this current year, positive as well. But also now that we're getting closer to potentially more rate cuts. Like I said, one or two at the Federal Reserve, maybe another one at Bank of Canada. European Union probably will cut rates. That is, again, a positive tailwind to the fixed income space. And so certainly there's a lot more positive momentum generally in an uncertain environment. Again, tariffs and trade wars are still going to dominate the conversation, and that won't go away. However, markets like certainty, I've said this before, and they know tariffs are not going to go away. It's just what the number is. And so markets and economies will evolve around that. And like I said, right now there's enough positive momentum on both asset classes to say that so far things will be okay through Q3. Time will tell. We'll leave it at that. I do thank you for joining us and spending the time. We look forward to you to joining us again at the end of Q3. Take care. Bye for now.